Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Adrianne Yamaki, founder and financial advisor at Strategic Wealth Capital, to discuss appropriate diversification and where the opportunities are right now. Adrianne, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me.
All right, so what are you doing for your clients right now? Where are you seeing the opportunities?
So it's interesting. Right now, even more than ever, we're looking internationally. So it's always the case that if you're properly diversified, it's important to have not just US companies of large, small, different market caps, but especially internationally. International is very, very broad. It includes very large cap blue chip developed companies, say in Europe, and it also includes a lot of emerging markets. So it's always important to be diversified, but particularly now, international is particularly compelling.
Why do U.S. investors tend to overlook international investments?
It's interesting. We all, as humans, and this is true for advisors, portfolio managers, we tend to suffer from somewhat of a home country bias. So the way we perceive risk is that something that we're familiar with, we perceive as having less risk. And a lot of the largest companies in the S&P, Apple, Google, are companies that we're very familiar with as consumers. So we perceive them as less risk. However, there are a lot of companies based abroad, domiciled abroad, that are extremely profitable, high revenue, and they may not come to mind immediately, but they're very, very strong companies with good revenue. They just happen to be domiciled outside the US.
And Adrianne, the narrative in the market right now is potentially going into a recession. So why is now a compelling time for international?
Right now is a good time for international for a couple of reasons. First is what you pay for a company matters. And if you look at the US and what we're paying for using the S&P as a proxy, the PE of the S&P right now is close to 17%. But if we look elsewhere, for example, if we just take a look at the All Country World Index, the ACWI, it's trading closer to 12%. So the PEs are much, much more favorable for the same dollar of earnings. You're paying a lot less for those indexes and for those specific companies. So especially looking at a recession and looking at an earnings recession, it's important to look at what are the valuations and what are we truly paying for those investments.
And finally, are there different risks in investing internationally, and how would you mitigate those?
So we all know the standard risk was investing internationally. One is that the US dollar has been classically very, very strong. And the second is, which is true depending on the country, is that transparency into reporting, they're not as stringent and not as consistent as the US. And there's certain ways to mitigate it. One way is to consider investing using active management and active portfolio managers, where you have large teams on the ground that know the companies, know the players, know the management of the company, and can really discern between numbers that maybe if you kick them a bit harder are quite sturdy, and those which we should probably take with a grain of salt.
All right, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.